Welcome back to CPA Mastery. In this lesson we begin a new section of the regulation exam. Itemized deductions. Itemized deductions reduce a taxpayer's taxable income by allowing certain personal expenditures to be deducted on the tax return. However, taxpayers may only claim itemized deductions if the total exceeds the standard deduction. Because of this rule, the first step is always determining whether a taxpayer should itemize or claim the standard deduction. The CPA exam frequently tests this comparison. By the end of this lesson, you should understand what itemized deductions are, how they differ from the standard deduction, and the major categories of itemized deductions tested on the CPA exam. In this lesson we will focus on three primary objectives. First, we will define itemized deductions and understand how they reduce taxable income. Second, we will compare itemized deductions with the standard deduction to determine when itemizing provides a greater tax benefit. Finally, we will introduce the major categories of itemized deductions that appear on the CPA exam. These categories include medical expenses, state and local taxes, mortgage interest, charitable contributions, and casualty losses. Understanding the structure of itemized deductions will make the individual rules much easier to learn in later lessons. Itemized deductions are specific personal expenses that taxpayers are allowed to deduct from their income when calculating taxable income. These deductions are listed individually on Schedule A of the individual tax return. Instead of claiming a fixed deduction amount, the taxpayer lists qualifying expenses and deducts the total. The purpose of itemized deductions is to recognize certain personal expenditures that Congress has decided should receive favorable tax treatment. Taxpayers must choose between claiming the standard deduction or itemizing deductions. The standard deduction is a fixed amount determined by filing status. Itemized deductions depend on the taxpayer's actual qualifying expenses. Because a taxpayer cannot claim both, the correct approach is to compare the two amounts and select whichever deduction produces the greater tax benefit. Several major categories of itemized deductions are frequently tested on the CPA exam. Medical expenses may be deductible when they exceed a certain percentage of adjusted gross income. State and local taxes, often referred to as SALT deductions, may also be deductible within certain limits. Mortgage interest paid on qualified home loans is another common deduction, and charitable contributions to qualified organizations may also be deducted when specific requirements are met. Suppose a taxpayer has $12,000 of qualifying itemized deductions. If the standard deduction for that taxpayer's filing status is $14,600, the taxpayer would claim the standard deduction. This is because the standard deduction provides the larger reduction in taxable income. The CPA exam frequently tests this comparison to ensure students understand that taxpayers choose whichever deduction produces the greatest benefit. Now consider a taxpayer with $18,000 of qualifying itemized deductions. If the standard deduction is $14,600, the taxpayer would choose to itemize because the itemized deductions produce a larger reduction in taxable income. This simple comparison appears frequently in CPA exam questions. A typical CPA exam question may provide several deductible expenses and ask you to determine whether the taxpayer should itemize or claim the standard deduction. Your job is to calculate the total itemized deductions and compare them to the standard deduction for that filing status. The taxpayer then chooses whichever deduction produces the larger reduction in taxable income. A helpful exam strategy is to always calculate both the itemized deduction total and the standard deduction amount. Some students assume itemizing is automatically better, but this is not always true. Many taxpayers benefit more from the standard deduction. The CPA exam may intentionally include itemized deductions that appear large but are still smaller than the standard deduction. Itemized deductions allow taxpayers to deduct certain qualifying personal expenses from income when calculating taxable income. However, taxpayers must choose between claiming the standard deduction or itemizing deductions. because only one option may be used. The correct approach is to compare both amounts and select whichever deduction provides the greater reduction in taxable income.